Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark talks about the dramatic effect of Japan's new economic stimulus plan. Gerald Celente from the Trends Journal has an inspiring retirement tale about a couple in their 90s. And Venture Capital Market Association President Don Mosher on how overregulation is killing jobs. We talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, CIBC Wood Gundy Investment Advisor. He's speaking to us from Vancouver. Welcome to This Week in Money, Ross.
And it's nice to be back.
The land of the rising sun provided some excitement for us late in the week, bringing in their own version of quantitative easing.
This was the shock and awe from the Japanese. As of Friday night, they came out and said that the QE that they had was not quite enough, and it was time to up the ante. So they were doing it in big numbers. Basically, they're taking their purchases of government bonds and almost doubling that. They're looking to increase by 3 times the amount of equity they're going to put into exchange-traded fund purchases. They're also tripling the REIT purchases, which for the Japanese, where their big concern is the fact that prices have not been rising. They do want to get inflation up. So, helping the REIT market, in effect, puts a bid into the property market there. The lenders will feel more comfortable about it. And this infusion by the Japanese had just an immediate impact worldwide in terms of the currency action right off the bat. Japanese yen dropping about 2.5% on the day in just a matter of seconds, and the equity market in Japan just loved it, up 4.5%. And, as far as what it did for North America, we were already coming off that very, very oversold low 2.5 weeks ago. We're picking up a bit of momentum, once again after the FOMC meeting, the Federal Open Market Committee meeting, in the U.S. this week. This just put fuel to the fire. So, new all-time high close for the S&P and for the Dow Industrials.
Ross, any coincidence that just as the U.S. announces the end to quantitative easing, Japan comes out with this hugely large program? Maybe explain how big this program is and what kind of impact it's going to have going out over, say, the next few weeks.
Well, I mean, the program is monstrous. I mean, here the JGB purchases, 50 trillion yen now are going up to 80. Now that's 500 billion US dollars, in terms of the size of this thing. It's just very, very large, and it's open-ended. They are not putting any time limits on this, and they've also expanded on the bonds from going from just the 5 years. They're now going to be buying 7 to 10-year bonds. So it's got quite a long-term implication, and it's we know that after the QE1 and QE2 in the U.S., the markets topped out 2 to 3 weeks later, and this was very, very well known. And I think that there, has been some expectation from the analysts that with the end of QE in the U.S. this week, that we could be looking at an easing back in the equity markets as we moved into November, December, just for the fact that QE had unwound and there was no more infusion of capital there. So this move by the Japanese, it definitely looks to be a little bit more than coincident. I see that the vote by the Bank of Japan, it was a 5-4 vote to do this. The previous one on the original QQE was an 8-to-1, much more, definitive. So this one was really, pushed through with a very narrow margin.
Goldman Sachs has made a prediction that by the end of the year, the price of gold could be about $1,000. What are your thoughts on that?
Well, now that we've taken out this support at 1190, and we had 3 or 4 tests of that support, I take a look back and say, what's the characteristic here for the gold market when it does this type of thing? And there's maybe 10 examples that if we look back over the last 30 or 40 years. And the most common thing to have happen is that you get this initial break, you get a pause right around the level that you've broken from, but it's the decline from here generally will take weeks, not days, in order to find a bottom. And in terms of the height of the consolidation that we've come out of here, we say we had this floor at 1190. We've had progressively lower resistance levels for the last year. And this type of descending pattern, a descending triangle we call it, if we were to break the height of that pattern, you can end up with targets in the 985 to 1070 range. That would not be at all out of line with the type of pattern that we see here. What I would look at, though, is the fact that the mining stocks have been under pressure, significant pressure, since the second week of September. And it's now, we've had, the work that I do, we've had 9 consecutive weeks of sell-off. We end up with a relative strength reading that is as low as what we saw around some of the major bottoms, 1976, 1982, some of the big ones. And there's only 4 or 5 times that we've been this oversold on the mining index. So normally we'd expect to see them bottom out within the next 2 to 3 weeks, because oversold doesn't mean you have to turn, just means that you're moving down at probably too fast a rate. So I'd expect to see them find some support fairly soon and try and have a bounce. Now the key, breaking that 1190, that triple bottom that we had, is that the eventual low, when we look at them, happens once the miners start to outperform the bullion. So that as we might be stair-stepping down in gold prices, if we start to stair-step up in the bullion, in the mining stocks, that becomes what we would call a divergent low. And that's the type of thing that we'll be watching for in the coming weeks and months.
Ross, how can people get a hold of you?
My number here in Vancouver is 604-661-7759, and the email address is ross.clark, C-L-A-R-K, at cibc.ca.
Ross, thanks for a lot for being on This Week in Money.
Thank you, Jim.
After the break, Gerald Celente on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Gerald Celente, publisher of the Trends Journal, which you can find online at trendsresearch.com. Gerald speaking to us from Kingston, New York. Welcome to This Week in Money, Gerald.
Oh, thanks for having me on.
Well, talk about trends. We have a lot to talk about today. First of all, let's hit off with our big buddies, gold and silver. What's the long-term outlook there?
Well, as part of the Trends Journal, that's a quarterly, we send out a Trends Monthly. And a few days ago, the Trends Monthly went out, and I did a piece on gold. And the point that I keep making is that the reason why the equity markets are doing what they're doing, as most people know, is because of all the money being juiced into it, the quantitative easing. And now we just heard from the Bank of Japan that's going to send in nearly $800 billion into their failed economy already because Abenomics has not been working. And their largest pension fund announced that, and the pension fund, by the way, is about $1.4 trillion. It's the largest in the world. They're going to be buying stock at a much higher rate, not only in Japan, but internationally. So you saw the boost go up. So what's happening is the markets are going up, the equity markets are flying high, and then you look at the latest forecast coming out of Europe, Germany even, and it's recession or going into one. So this is an artificial market that it's bearish for gold as long as the equity markets keep booming the way they are, and until this Ponzi scheme ends. And you're seeing the same thing happening in China. Their central bank also announced that they're pushing in more funds. You're looking at housing prices in China. They were up, about 27% in 2013. They're already down over 10%. So that housing bubble is bursting. So what we're looking at is, as long as the central banks keep dumping dough in and pumping up the equity markets, it's going to be bearish for gold. And on that trend alert, by the way, that the Trends Monthly that we sent out a few days ago, what I mentioned was that I can see a downside of gold going to, another $100, $150, and that was when gold was a little over $1,200. And I can see that happening. But in the long term, I make it very clear, gold is for my golden years. I've been buying gold since 1978. My first buy was $187.50 an ounce. Now is, even it's worse. We're talking about 1,180, 87. And so you look at, the rise since then and look at the devaluation of the dollar since that time. So for me, gold is a long-term play. And it's very important to note that, coincidentally, the Bank of Japan raised its enormous amount of quantitative easing, and their pension fund went into a stock buying spree as they cut back on bonds, as the pension fund cut back on bonds, but the Japanese government, the Bank of Japan, bought bonds. But they did all of this just 2 days after the Fed announces the end of quantitative easing. Coincidence? Happy Halloween. Trick or treat.
I was just going to ask about that. What a coincidence.
It's no coincidence. It's picking up the papers every day virtually and seeing how the game is rigged, whether it's the probes going into looking at Forex or LIBOR or rigging the stock market with their high-frequency trading that's getting the information before anyone else is getting it, or looking at all the criminal acts that have been committed by the banks. It's no coincidence. They're all in collusion. And now, by the way, the European Central Bank is also talking about their definition and what they're going to do to juice that flagging economy as well. They call it a deflationary economy. A German bank announced this week that if you put in, if you're a business or individual and have over 500,000 euros in your account, negative interest rate at 0.25%, which means, in real language, you have to pay the bank that much on your dough for them to hold it. Oh yeah, there's a recovery, I tell you.
That's really going to encourage saving, won't it?
Well, that's it. All this is doing, it's encouraging speculation. It encourages the merger and acquisition crowd, and it encourages the buyback of stocks that companies have been doing because of the record low interest rates. And interest rates in the U.S. have not been raised since 2006.
So how is this going to influence the long-term outlook on gold and silver?
Again, it's going to influence it when the Ponzi scheme ends, because all of this, like I said, they have interest rates are at record lows in most of the Western countries, and what they're doing is they're allowing all of this merger and acquisition activity and stock buying programs to continue. When interest rates go up, the Ponzi scheme is over, and you're going to see the shutters close on the equity markets. Then they're going to come up with another round of easing that'll be greater than the one that they have. That's when we're forecasting gold prices will go back up. But panic has to hit first, and it won't hit until they have to do something to come out with a new line of how they're going to juice the economy with more fake money. As I look at it, in a story we did in the Trends Monthly, bucks, bitcoins, or gold. And when you look at bitcoins, where they're about $350. A year ago, they were what? Over 1,100. The dollar, the dollar's doing better than it has, since the panic of '08. when it was almost hitting $1.50 to the euro, and now it's around $1.25, and gold is down from its highs. But why would I want to invest in bitcoins, bucks, or any fiat currency when I know what the Ponzi scheme is? So I'm in it for the long term. And again, I don't see gold going back up until there's a financial crisis and they have to put more liquidity into the marketplace in the States.
Oil and natural gas, what's the trend there?
Again, that's telling you where the markets are going. I mean, you're looking at, Brent crude, going under $85 a barrel. It's down to 25-year lows in West Texas as well, hitting 79. These are 25% lows just since June. That's telling you where the global economy is. Yes, there is more supply, undoubtedly, but demand is way down, particularly in Europe. Oh, and then those brilliant geopolitic, mindful people that run our governments, they put sanctions on Russia. Perfect. Put sanctions on Russia at a time when the economies in Europe are softening. Brilliant strategy. So now you're looking at trade slowing down in Germany, in Europe, and in Russia. So what it's doing, it's depressing the prices even more. And then you have major suppliers like Saudi Arabia and others that are lowering their prices, trying to push the other people out of the market. So this is, to me, more of a demand than a supply issue. Again, supply is up undoubtedly, but demand is down. Oil prices, to me, are telling the future, and the future is the economy is soft.
The Dow and the S&P 500, what's happening there?
Again, it's speculation because of all the cheap dough flowing in and the ability to borrow money cheaply. You're looking at the Fed is holding interest rates near zero, and the big borrowers are borrowing very cheaply, buying up their stock. Again, I'm not making this stuff up. You look at the numbers on mergers and acquisitions for the first half of 2014, they're back to 2007 levels and above. So the equity markets will continue to rise as long as there's cheap money to fuel them until a crisis hits.
Some have predicted perhaps that'll stretch out for about 6 months. Then after that, maybe 6 years of doom and gloom.
You never know. Timing is very difficult in this business. And that has been, when I thought that things would collapse in 2010. I didn't know they'd come up with a term called quantitative easing and get away with it. I never dreamt that they would keep interest rates low for over 8 years. And I would never dream today that the Bank of Japan, after having a failure right in front of them with Abenomics, would double up on it. And when you look at, by the way, what they're doing and the amount of quantitative easing, compare their economy to the United States economy, their quantitative easing is 4 times greater. And then again, with the pension fund buying up global stocks, that'll boost the markets. The other thing, the wild cards that nobody can predict. And a wild card to look for is a terror strike. False flag or real. The United States and NATO are expanding their reach into Syria now. They've declared war against Syria. They're bombing a foreign country. How many people are they going to kill before the people are going to get even in the countries that they've attacked? And, as we used to say in the Bronx, payback's a bitch. How many millions, they beheaded. Oh, look at these ISIS. They beheaded people. NATO has killed over 1 million people in Iraq and Afghanistan. You think there are a lot of angry people that have seen their lives destroyed, their country destroyed, and their futures destroyed? So something like that could really rattle the markets. A 9/11 magnitude strike will bring this phony market back down to its levels where it should be. And then you'll see gold prices take off.
What's happening with real estate and China?
The boom is busted, and now you're also looking about the all that hot money and that shadow banking going on in China and around the world. They're starting to cut back on it, and again, you're seeing the Chinese real estate market from being up nearly over 27% in 2013, being down 10% or more already this year. So what's going on in China? They're buying up the world. Look what's going on. The first trip that the new president of Afghanistan made was to China. So America and Canada and the rest of the allies blow up the joint, and China goes in and builds it up. There's China boomtowns all over the world because the smart money's leaving over there that made the big money, and they're buying up around the world. So that's what's going on. They cannot sustain the Chinese 25% of China's GDP or thereabouts, maybe even higher, is pegged to real estate. That's enormous. So as that real estate market declines, so too does the Chinese economy.
Your latest Trends Journal has an inspirational video. Can you maybe tell us about how to skip old age, the boomer renaissance, and so on?
That's my favorite video we've ever done. It's on June and Stanley Blum. They're 95 years old, and they're real inspiration. Stanley's just completed his 4th book. He began painting at 80. He used to be a shoe salesman. He said he was a slow learner. And his artwork is terrific. His latest book is called A Roll in the Hay. And wonderful poetry and beautiful inspiration, both people. And they live in Rhinebeck, which is about a half hour from Colonial Kingston. They drive over here. And I'll pick them up. We'll go out to dinner. We won't get back until 11 o'clock at night. And June, who's a psychologist, said, we're skipping old age. She said, yeah, you slow down. You know, your mobility isn't what it used to be. But you keep learning more and doing more and growing as you get older. You've been around long enough to know what the score is. So you keep growing and living a life that you should aspire to rather than retiring in more ways than one, retiring mentally as well. So they just keep learning and growing, and it's there for anybody to watch, by the way. All they have to go to is to go to our trendsresearch.com or trendsjournal.com. Go to the conferences, and we had them at our latest conference over here, and you can watch the video. Very inspiring. So don't retire, just rejuvenate. And as the baby boomers keep, you know, we're hitting those ages now where we're getting retirement, you know, they're just pushing through and creating more. And that's really the message. No time to stop. You want to live before you die.
And with the baby boomers hitting retirement age, I said they're not all going to instantly become Frank Sinatra fans if they weren't before. They're still going to be listening to Led Zeppelin, for God's sakes.
Yeah, and maybe creating something new as well. And one of the trends we're going to be coming up with 2015, by the way, is we're not going to call it nostalgia, but it's something else going back to bring back higher quality in many different fields. So, and music being one of those, unless, you know, rap isn't music. You can call it what you want. There are no instruments in it. You know, you could call it poetry, but you don't have to know how to play a great violin, piano, trumpet, or anything else to do rap. And the food as well. The biggest trends that we see, the big money-making trends that we see, by the way, are going to be in food, clean food, and clean water. You know, you may have rain up there, but it's dry in a lot of other places, from Brazil to California to around the world. And high-quality food is getting harder and harder to come by. So as the baby boomers age and quality goes up in their minds, the market for quality grows with it.
And besides, when you get older, you appreciate things that last. If you've lasted that long, why can't your products?
Exactly. And again, you know, my father, may his soul rest in peace, we'd be eating dinner when I was a young guy, and he'd look at me and he'd say, you know, son, they say that youth is wasted on the young. And then he'd take a couple more bites and he'd look at me again and he'd point his finger at me and he said, they were talking about you.
And of course now we have medications that can perk up your older age.
Well, you know, you could do that or you could do it natural, you know. But really, you know, as you get older, you learn more if you keep learning. And again, at one time in civilization, they used to honor the ancestors for what they knew and what they bring and what they gave. And we've kind of lost that now, particularly in Western civilization. So you honored the ancestors because they've been around longer than you and they knew a lot more, and you learn from them if you're open to learning. So June and Stanley Blum are really, to me, inspirations to learn from.
Gerald, always a great time talking to you. How can people find out more about Trends Research?
Trendsresearch.com, trendsresearch.com. We have the Trends Journal Quarterly, Trends Journal Monthly, and every weekday we do Trends in the News, the real news to put you ahead of the news and on top of the trends.
Gerald, we'll be chatting with you soon. Thanks a lot for being on This Week in Money.
Thank you, Jim.
After the break, Venture Capital Market Association President Don Mosher on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Don Mosher, President of the Venture Capital Market Association. Welcome to This Week in Money, Don.
Thank you very much, Jim.
Maybe you could first of all explain to us what exactly is the Venture Capital Market Association.
It's a platform that Joe Martin and myself created to try and give the venture industry something to speak from. It's a very fragmented industry. It's been under attack by regulators. The barriers have been erected that really prevent the flow of capital coming in and financing startups. And it all started with me phoning up Joe Martin one day and ranting and raving about a newspaper article. Joe going, "Why should I care?" And me saying, "They're going to put you out of business, Joe. These are your clients that can't raise money, and therefore they won't be able to attend your conference anymore." So this happened almost 2 years ago. And since we started to speak out on this, we've watched the venture index drop to basically 2008 lows. The regulators will tell you, no, it's not us, it's other effects on it. I think it's a combination of factors myself. I'm not going to fully blame it on the regulators out there, but at the same time, they haven't helped at all. And when I'm talking about the regulators, I'm talking about the securities commissions in each province, and the ultimate bad guy, in my opinion, is IROC, which oversees all the licensed brokers in Canada. They have continued to put regulations in place that have forced over 20 membership companies out of business. They've dropped out for a multiple of reasons, some of them just saying we can't justify the costs to stay in business. And really what IROC has done is impose U.S.-style liability on each and every licensed broker in Canada, which really takes away any incentive that they would have to recommend any kind of junior or venture deal to any of their clients. And that's really forcing anybody who wants to play this market into discount brokerage accounts. And then it becomes, how do the deal makers in Canada reach out to these investors that used to get tips and deal flow through fully licensed brokers? Now they're really out there isolated amongst themselves on their own. So the model's broken, and it really needs to be rebuilt by the younger generation, the 20 and 30-year-olds that have an interest in wealth creation and job creation and innovation and all the rest of it have to go out there and really help us old guys through social media and other outlets to communicate with the investment community.
It seems overregulation is forcing people to go into group financing, which has no regulation at all.
Crowdfunding,
yes.
Yeah, and you know, the U.S. recognized this problem a few years ago, and they instituted the Jobs Act, which stands for Jumpstart Our Business Startups. But the SEC has really dragged their feet on approving any kind of crowdfunding down in the U.S., even with Obama pushing on it. And the issue that we have in Canada is our regulators are using the United States as a model to run our markets by. For example, the CEO of IROC is a woman named Susan Wolberg-Jonah, and she's just recently announced her resignation. But what she's going to do is go down and sit on the SEC board. And that's an example of how these U.S. regulations are being viewed by the Canadian regulators as a model to run our markets by, without any regard for the fact that, unlike the U.S., we're very much resource-based. We're very dependent on jobs that are created by people going out and finding oil and gas projects or mineral deposits, as well as the lumber industry and fisheries and all the rest of it. But if you take a look at the Canadian economy, we are very dependent on the resources. Down in the U.S., they have a large manufacturing and export business, and they can afford to do some of this stuff. Their private equity funds down in the U.S. are much larger than anything we have in Canada. We can't even come close to competing with what they're doing. So to be using their model and applying it to the Canadian economy is going to end up ultimately causing a real disaster up here.
Right, they're using regulations there to guide an elephant. Here you need something to harness a mouse.
Yeah, I mean, we need to embrace risk. We really do. Nothing that we do up here doesn't involve risk. You know, the oil sands, for example, was a brand new technology that took many, many years to show profitability. Now they've harnessed it, and, you know, we're one of the largest oil producers in the world with one of the largest oil resources in the entire world. If you take a look at a project like Highland Valley Copper here in British Columbia, I mean, it started out in 1962. It employs 1,000 people. It produces 1% of the global copper supply, 1.5% of the global moly supply. The closure date on that thing's 2025. So for, what's that work out to? 60 plus years, they've employed a very large workforce in an area in British Columbia that really had nothing going on prior to that. And each of those jobs, with a direct employed job at the mine, spins out 10 to 20 other jobs in the service sector and supporting that whole infrastructure. And you need to continue to move that forward. And the equity markets are very similar to that. So with the regulation that's IROC's imposing on the Canadian brokerage community, which obviously based on the numbers, if you look at IROC's membership as it dwindles away, is going to leave only very large institutions in place that really are not involved in venture funding at all. They'll come in there when you need to raise $500 million or $1 billion once you've gone through bankable feasibility. But prior to that, they have no interest in involving themselves into it. So as equities age and grow old and die, how are you going to replace them? And if you say to me, what are you talking about? You're talking like equities are organic in nature? Well, look at Nortel. Look at Lehman Brothers down in the U.S. It was one of the largest financial institutions in the world up until the 2007. And they really set off the 2008 crash when their demise, if you think about it. Up here, we're different. And we need to recognize we're different. We need to embrace the fact that we're different. And we need to have a whole different regulatory regime in place. We will not work on a U.S. model. So they're really good at putting regulations in place, but they don't have a clue on how to back off on regulations. They don't have a clue on what the repercussions on these regulations are. You know, an example of this would be this: people are in an uproar about the doing away of the uptick rule, and people allowing to slam bids from short positions and carry short positions and all the rest of it. So they sat down with IROC and they went over it. And IROC's response to that was, IROC does not anticipate taking an immediate action in regards to widening tick sizes. U.S. regulators have announced details on their planned pilot. The criteria applied for American definition of small cap would include a significant portion of the Canadian issuers. The definition of small cap in the U.S. is anything trading under $5. Well, I would say a significant portion of Canadian issuers, yes, would fall in under that $5 mark, right? In fact, the majority of the Canadian equities would fall in under that. When they brought in the down tick shorting rule, to create a meaningful tick rule, any implementation would establish and adhere to a universal last sale price across multiple marketplaces. Well, the reason the down tick rule can't be reestablished is because IROC, in their wisdom, has decided that there needs to be multiple trading platforms. So in the old days, it used to be, if you were the first person bidding on a stock, nobody else got to buy at that price till your order was filled. Now you'll put in orders on things and you'll get filled and you have no idea how it got filled because there was already 100,000 shares bid in front of you. And when you get filled, there's still 100,000 shares there. So how the hell did I get the fill? That's because of these multiple platforms. So they're not going to push back on that because it's too costly. Well, who owns the platforms? Hey, I think the banks own the platforms, don't they? And if you take a look at IROC and who's on the board of IROC, you know, the president of Chiax, which is one of the platforms, and all the rest of the banks. They're the people on there. You don't see a bunch of independent broker members on that board any way, shape, or form. So whatever the concerns of the small broker are, they're irrelevant to these regulatory officials. So the only way we can help them out is to go out and promote the value of small independent brokerage firms that actually help finance deals, cover small deals. They've got analyst coverage on it. They can do distribution into the Canadian public. We need to promote the value of that. Those are the people that actually fund our businesses out here, and they're the ones being eradicated by these regulations. And all you have to do is go to the IROC site and take a look at their notices and see how many of these guys have been forced to resign. And I'm talking, these aren't small little brokerage firms. There's a bunch of them that have done significant financings where you walked into their boardroom in the old days and there would be a tombstone for $150 million on the wall. No longer can justify to be an IROC member.
Some people are asking, should the Venture Capital Market Association even be involved in regulatory change?
No. No, I think if you take a look at it, the reason we built the association in the first place, where we were looking at the venture markets don't have a voice. They really need to somehow consolidate. But after a couple of years of chasing around after this thing, I've realized we really need to leave it to the lawyers and the brokers out there, the accountants. I mean, yeah, we're hurting, but according to John Kaiser, currently the venture companies just in Vancouver owe in excess of $2 billion. Who do they owe $2 billion to? I would say a majority of that is owed to lawyers and accountants in downtown Vancouver. So I'm not a lawyer, and I find it very frustrating and angering to even deal with the regulators. I think what we should be doing is promoting the value of the venture markets to the Canadian public and educating them. And, you know, right from preschool grade 1, I think our children are being told that the resource business is run by a bunch of bad people that are polluting the environment, they're causing hothouse gas problems, et cetera, et cetera. I don't think there's any room in the education system in Canada that tells them, listen, the resource sector in Canada is recognized as a global leader. It creates hundreds of thousands of jobs in Canada. It contributes billions of dollars in tax revenue in Canada. And as this industry has moved forward over the years, there's been huge advancements in how we protect the environment. When you go through all these environmental baseline studies, you're actually putting water out of the mine back into creeks that are purer than what the naturally occurring water was. So I think our job needs to be to go out and combat a bad education system, combat negative PR that comes out. Accidents are going to happen. It's inevitable. And it doesn't matter what sector you look at, it happens. A friend of my daughter's was run over yesterday on the highway and killed, but they didn't shut down number 1 highway because one person was killed. The tragedy that happened in Quebec, where those tanker cars exploded and incinerated 47 people and burnt down a town, doesn't mean that they've shut down the tracks, and they haven't even pulled off those tanker cars. Those tanker cars need to be replaced with more modern tanker cars. But in the meantime, you've got a very, very strong lobby group with the rail. Basically, we've got 2 railroads in Canada. So when the federal government goes to impose new regulations on the railroad industry, whether CN and CP hate each other, they will sit down together and they will lobby against those regulations, saying we can't afford them, we need more time to study them. Whatever is going on, they're addressing that issue as a unified force. But when you take a look at the mining industry, for example, you get a disaster like Mount Poly, but nobody got killed. There wasn't any property damage. There was a fear that they'd polluted the lake and the fish were going to die and it was going to affect the salmon run. At the end of the day, that was fear-mongering by environmental groups. Naturally, there's going to be some pollution involved in it, but the cleanup's going on. The industry will go out of its way to prevent anything further like that happening. But we're held hostage by the government and the politicians out there that just react. they react to the press. And we don't have a strong lobby group that stands up and says, hold on here. We need to study this properly. We need to take a look at the ramifications of it. We need to justify the costs. You know, you take an example, like we've got a BC government that said they want to permit 8 mines by 2015. That was their election platform. And you've got a company like Pacific Booker do all their environmental studies on Morrison Lake. The submission was 17,000 pages, and they got turned down because of a fear that they didn't adequately protect the salmon fishery below there. So you need to start to balance some of this stuff out. I mean, I'll argue that Mount Polley's partly a fault of the environmentalists. I mean, that tailings pond should be in a low-lying area, not up against a hill with 4 kilometers of dam wall running around it. So if the environmentalists are really worried about protecting the environment, they're going to push for sacrificing a swamp area or a small lake to hold the tailings and allow the development of an asset within the community to create jobs and move everything forward in a safe manner.
Out of those 8 mines promised by the BC government, how many will be online next year?
Well, Red Chris is supposed to come online here shortly, but of course Imperial Metals owns Mount Polley, and what kind of pressure is going to be applied to the politicians and the regulators to slow down the opening of Red Chris? I don't know. I can't answer that. I don't know if anything that's been permitted here in the last 6 months. And, you know, the mines are aging. They need to start to restore some of this. Here's a question for you. Will Mount Polley ever reopen? You know, the cleanup on that's going to probably be $150 million. And then will they ever re-permit that dam to be put back into an active situation with an active mine? I don't know. So does the likely area lose 300 jobs, 300 plus jobs directly employed by the mine, not counting all the spin-off jobs that I'm talking about, the stores and all the rest of the sectors? And how are you going to replace those 300 jobs there? They just extended the life of that mine. They went underground with it. And there's other mines around the province that are looking at end of mine life. Huckleberry is, I think, published to be 2021. Highland Valley's 2025. You're talking a lot of tax revenue disappearing, both just through the tax revenue from the mine and also from the revenue taxes that the employees are paying back to the government. We want all these social services and all the rest of this stuff that goes along with being a Canadian, but at the same time, we have to figure out how we're going to pay for all these benefits.
Ottawa's already warned us that with the big drop in the price of oil, it could take half a point out of our gross national product.
Correct. And that thing runs all the way down the line. As the U.S. dollar increases, I don't know the actual numbers, but I would think with the lack of funding going into the exploration that's created by the venture markets, you're probably looking at thousands of jobs that have been lost. And the guys that are putting up some of the barriers allowing us to access capital don't care, don't understand, don't want to hear about it. Because as opposed to rural Canada, which really relies on these jobs, urban Canada doesn't understand the benefits of the resource sector, it appears. I met with a politician here in town who, you know, was very active in local politics and now sits in Victoria. And he said he had no idea that Vancouver was the mining capital of the world. I'm not going to say his name because it's of no benefit. I'm just telling you, this is somebody that should know that. And he's been active in politics for 25 years here. How can you live in Vancouver and not be aware that this is a major mining hub in the world? So we're dealing with that from the political stat. We're dealing with ignorance of the Canadian public, of the politicians, and I think it's our job to start to actually educate and promote not only the mining business, but the venture business. And the venture businesses, the biotechs. Yeah, I talked to a friend this morning in the UK who really specializes in biotechs, and he asked me this question. He says, when does a biotech in Canada feel that they've achieved success? And I said, what, when they cure a disease or develop a drug or whatever? He says, no, absolutely not. When they acquire a U.S. listing, that's when they're successful. And that goes for a lot of our mining companies too. You take a look at how many mining companies through that bull market ended up getting at least dual listings in the U.S. At that point in time, they feel that they've really achieved success. We've now got a U.S. listing. So basically anything successful is going to the U.S. And in the meantime, we've got thousands of companies in trouble now. And there's a number of problems that it's causing. We've got, the TSX Venture Exchange, for example, is saying, no, we don't have that many problems. We can refinance. And I'm saying to them, if you really cared, the first thing you do is suspend the CPC program, because we've got enough public companies out there. There's no shortage of those. And a whack of them are shells now. They're looking for projects, and they're looking to consolidate, and they're looking to refinance and all the rest of it. So there's too many companies, there's too much paper, and they're still running a CPC program. How about let's take the investor who's already lost a bunch of money on a venture company that now consolidates, and at least allow that thing to be reborn with something else so he can maybe get back some of the money he's lost previously. Give some value to those shells. But if you continue to create CPCs, no intrinsic value to the existing shells that are listed.
Is the TXV just mining, and have you seen any cycles similar to the current one?
No, the venture exchange is supposed to encompass all sectors of the economy. Biotech, high-tech, lumber, mining, you name it. It's all embracing there. But yeah, I've seen two cycles that I consider very similar to this. Between 87 and 91, when the crash occurred, the senior markets rebounded in a hurry, but it took a long time for the junior markets to come back. I can remember in 1990, the guys at the firm I was working with were basically sitting around trading sports cards. The volume on the Vancouver Stock Exchange at the time was like 8 million shares a day. They'd just implemented the computer system, laid off everybody on the floor, and then the discovery up of Calpine Stikine that became the Homestake mine happened, and all of a sudden the exchange is doing 50 million shares a day or 55 million, and the computers are breaking down, and everybody had to come rushing back. Nobody could foresee that would trigger another mining frenzy, and that kept going until Bre-X happened. And then with Bre-X, the mining industry basically shut down again, all the way through till about 2003 or 4. And during that area, that was the Y2K era. That's when everybody was getting into the internet sector and all the rest of it. So we had all these geos in Vancouver running high-tech companies. And then in 2004, of course, the whole thing happened again, and guys went back into the mining business. Well, now we're seeing people going into pot deals, and we're seeing them looking for high-tech deals. And so they're trying to reinvent themselves, which is a natural occurrence for people in the venture business.
Don, thanks a lot for chatting with us.
My pleasure.
Don Mosher is president of the Venture Capital Market Association. You can find their website at venturecanada.org. Thanks for listening. That wraps up this week's show. Ross Clark from CIBC Wood Gundy will be back with us next week. And thanks to our other guests on this show, Gerald Celente and Don Mosher. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.